Greetings everyone. This is King Solomon, and in today's video, we'll be looking into a topic that is titled zone refinement. All right, so this video is going to simply explain how you can refine your zones and how correctly it should be done when it comes to the time frame biases here. So, of course, most of you refine your zones. Most of you will take trades on from proper and valid POIs, and then you want to go to lower time frame. You want to take, you want to make the zone smaller, right? You want to get a much more smaller zone so it can increase your risk to reward, because that's the sole aim of refining your zone. You want to get a better risk to reward ratio on your trade, right? There might be other reasons for zone refinement, but then as long as this video is concerned, I'll be breaking it down to how you can take this trades from refined zones, yeah, and then leading to greater RR on your trades. So let's dive into the video already. Sure that most of you have studied zone refinement before, and maybe there are some of you that don't refine your zones. But then let's just see what it's all about. Zone refinement, I would say, is taking your zones from the much more lower time frame compared to the main time frame you analyzed on, right? So I made a simple time frame strategic analysis to follow right here, and that's refinement, the refinement of your time frames. Well, this should be time frames refinement, right? But then let's just look at it. I said from the monthly, we can analyze our zone. We can refine our zones down to the weekly time frame. From the weekly time frame, we can refine our zones down to the daily time frame, right? And from the daily time frame, we can refine our zones down to the 4 hours time frame. From the 4 hours time frame, we can refine our zones down to the 1 hour time frame. From the 1 hour time frame, we can refine our zones down to the 15 minutes time frame. From the 15 minutes, we can do that down to the 5 minutes, from the 5 minutes to the 3 minutes, and from the 3 minutes to the 1 minute time frame. And then I added something which is as well as important as what has been said, yeah, that don't double refine. What do I mean by don't double refine? It means, let's say you mapped your structure and your other block, right, or your point of interest from a time frame. You want to refine only once. You don't want to go twice, right? From the monthly time frame to the weekly time frame is okay. You don't want to refine to the weekly time frame and then trying to refine to the daily time frame, just because you want to get a super small POI, yeah. So it might work if you get your daily time frame from the monthly time frame zone, yeah. But then what you're going to experience over time is you're going to be missing so much of your valid trades, right? Even for those who refine their zones, I will tell you that some of the times we still miss entries because of the zones that were refined. But if you follow this uh this neat procedure, right, in refining your zones, it's not only going to let you not miss much trades, right? It's as well going to help you with the proper and valid lower time frame confirmations. Now let's see. I'm not sure if okay. I'm going to do something now. I'm going to show you how to mark your proper zone. So in the case of a downtrend, right? Let's say when a downtrend does this, yeah, when a downtrend does this, your supply zone right? Your supply zone is going to be the last bullish candle before the sell. The last bullish candle before the sell. And then a criteria is involved is paramount in this, and that's that candlestick should be an engulfing candlestick, meaning you want to see that that candlestick actually took out liquidity from the former candlestick. Let's see what I mean by that. Let's say this is the come down, which you can mark this low as a break of structure, right? You can mark this as a break of structure, right? A BOS. So marking this as a break of structure, according to that, this is a sell. You want to look for the last bullish candle before this bearish move. This downtrend is a bearish move, so you want to look for its opposite candle. That you want to look for the last bullish candle before this bearish move, and that candle must be an engulfing candlestick. So you want to see that that candle did something like this. Let's make this a bullish candle here, and then let's say its candlestick is as this. Its stick is as this, right? It's weak, and let's say there's a former candlestick before this. Let's say we add a sell. Yeah, let's say we had a sell candlestick just before it, and then its candlestick is as this. So what you want to make sure, what you want to make sure is that this candle, this candlestick, right, the wick of your candlestick went above the former candlestick. So if we're having something like this, I'm not going to be marking this as my order block, as my supply zone here. I want to make sure that my wick went above this former wick. That means it engulfed it. Yeah, looking at something like this. Okay, I'm going to be making use of my brush, right? Like this, right? So this went above this. You can see that there's that trade past the former candlestick, right? So it means price was able to grab liquidity from the former candlestick. And then you want to make sure that it's a bullish candlestick before the bearish move that's caused the break of structure. So that's how you can mark, that's how you're going to be marking your supply zones. Yeah, and when it comes to the demand zone, it's going to be the opposite. So let's say this is okay. Let's use the case of let's use this in the case of an uptrend where we have something like this, yeah, and this, right? And then this candlestick is here. So what you want to make sure is that the candlestick you want to use for this bullish move is a bearish candlestick, right? That's the opposite. We made a bullish move to break structure. You want to find a bearish candlestick to mark as your demand zone, right? And then following what I told you, yeah, said the bearish candlestick must take out liquidity from the former candlestick, right? So it means we want to see something like this. Let's say this is an up candle. Okay. No, no, this is going to be an up candle, right? And then this is going to be the wick, right? So we know that once we want to make use of the bearish candle, but then we want to make sure that this candlestick took out liquidity as well. So how will you ensure that? How will you see that it took out liquidity? That means it swept the low of the last candlestick. You can see this low going below this low, right? Swept the low, grabbed the liquidity around there, right? So just follow that pattern. Don't be bothered about it being or it just trading past it and closing around here. Just follow the two confluences of the opposite candlestick of the trend bias and it being an engulfing candlestick, right? So it means you can now mark this as your order block here, this as your order block, There's one important thing I'm going to show you guys as well. Maybe in coming videos, I'm going to make a video on how to mark your how to correctly mark your zones, right? How to correctly mark your POIs, and I'll probably even be diving into other point of interest types, right? Not just only your demand zone and your supply zone alone, but your other block, should I say, right? So that being said, let's see what next we can have. So there is something that I just see on the chart, and just having this understanding alone, you may not be able to undo that when you see it. All right. So I would want to show you guys. So let's say we have something like this here, and then we have other candlesticks past it. Now, a very important confluence for marking this candlestick as well, right, is the presence of an FVG. Yeah, I did not say that earlier. Is the presence of an FVG. You need to see a gap between the high of the candlestick and the low of the third candlestick, right? So if this is the candlestick you are using as your zone, this is the first candlestick, neglect the second one and look at the third one. So what you want to do is you want to mark the eye of that candlestick. If it's a demand zone, yeah, you want to mark the eye, right? You want to mark the eye as this. You want to mark the eye as this. I think that's straight, right? Horizontal. You want to mark the eye as this, and you want to mark the low of the third candlestick. So if there's a gap here, right? If there's a gap here, it means you can use it as your zone, because price is going to magnet this gap, and this gap is going to get filled, tap into your zone, and then boom. Understood? So what if in the case where this candlestick, this zone actually does not have like a an FVG, right? Or a fair value gap, FVG fair value gap, inefficiency, they're all the same thing, all right? So what if it does not have a gap? What can you do? Just use the next candlestick after it, irrespective of its color, yeah? Irrespective if it's the green or the red, irrespective if it's the bullish or the bearish candlestick, just use the next candlestick. As long as that candlestick has an FVG to its own third candlestick. So this one does not have an FVG to its third candlestick, but then if this one has an FVG to its third candlestick, meaning if there's a candlestick thereafter here, right, then now has an FVG. Yeah, then now has an FVG gap as this. Right, a gap as this, then you want to make use of this one as your other block. So this space here is what price is going to magnet. Price is going to go with the next candlestick. So instead of this one, you're going to use this one as your other block, right? As your other block. So on here, and this as a green candlestick, right? So that being said, that has even actually pretty much explained how to mark your normal zones here. So now it will be easy for you to understand what I'm explaining this zone refinement video. So looking at this, according to what you just learned now, we know that we want to look for a bullish candlestick before the bearish structural market break here. And then spotting this, as long as this candlestick, let's assume that this candlestick actually took a different from a candlestick, we're marking this as our OB, yeah? And now, how do you mark it? You mark it from the body to the other side of the wick. It means in this bullish case, you don't want to mark it from this place. Yeah, you want to mark it from the body, right? Taken from the body all the way to its eye. And if it's in the case of a bearish candlestick, you want to mark it from its body as well. Let's say this is actually something like this, right? And then to mark out the candlestick. Let's say this candlestick actually took a liquidity from the candlestick. you won't mark this zone as this, right? You're rather going to mark it from this body to its low. Do you get now? That being said, we can now move to the next phase of study. So looking at this time frame, I put this as a 4-hour time frame. And according to this, what do you see? We can analyze, we can refine our zones from the 4-hour time frame to the what? The 1-hour time frame. So from this 4-hour time frame that you got to your valid zone, you want to go to the 1-hour time frame, right? To see the valid zone that can be used as well. Yeah. So looking at this, right? You can see that this is the 1-hour time frame, there's one candlestick, and then this being the 1-hour time frame, the 4-hour time frame, one candlestick, the 1-hour time frame, 4 candlesticks here, right? I just did this drawing to like make it look real so you can understand better, right? So this being the candle, this being the 4 candlesticks, you want to now mark out your zone. Now, even though you're going to the lower time frame to mark out a new zone, you still want to stick to your confluences on picking your valid order block, right? And looking at this, since we sold, we want to look for the bearish candlestick that went above the last high, the last candlestick, right? And this candlestick went above its last candlestick, right? We're assuming that this has an inefficiency, okay? Once it has an inefficiency, that's a magnet for price to what? Come back, feel this inefficiency, tap into our zone and what? Boom. Yeah. So looking at these confluences, this candlestick is still a bullish candlestick, right? The correct supply zone to pick for this bearish market change in structure, yeah, and market break in structure, I mean. And it has an FVG, and it took our liquidity from the former candlestick. It can obviously see that, can literally see that this high went above the high of this former candlestick, right? Let's say this was actually what is here. Do you think we can use this as the correct zone? Do you think that? Okay, if you pick no, you're correct. If you pick yes, you're correct. Why? Because we can still make use of this if there is an FVG, right? Don't forget what I told you below here. I told you that you can use the next candlestick, right? Since this one did not take out liquidity from former candlestick, it means this particular one that did is the main zone, right? Is the main zone, but you don't want to use it probably because it is a bearish candlestick on a bearish structure, right? So you can go for the next one if it actually has an FVG. So that's simply how to mark out your zones, right? And following the this. So imagine this was the monthly time frame. We're analyzing here to the what? To the weekly. From the weekly to the daily, right? 4 hours to the 1 hour. So let's say you analyze on the 15 minutes time frame and you picked your zone on the 15 minutes time frame. You just want to go down to the 5 minutes time frame to refine. Now imagine we're going from the 4 hour to the 1 hour, right? And then we now want to go from this 1 hour again to the 15 minutes for a smaller zone. You might get a missed entry, right? But in most of the cases, you can simply follow this time frame refinement rules. You would pick a very high percentage of your trades that would prevent you from missed entries, right? So now what's the importance in this? We can see that price actually this one, right, that wasn't refined, it was around a 2-hour trade. This one that was refined was around a 4-hour trade plus, right? So that's just how it is. So someone who took this one and made $200, you would have taken the same thing and made around $400 plus, yeah? So let's just look at the charts for maybe one example for better understanding, all right? So guys, looking at this very nice example on GBP/USD. This is the weekly time frame, as you can see. Looking at this, we can see the price tapped into this zone, came down to break structure here, right? And now what do you want to see? You want to know that price coming to this low, going up here and coming down to break structure caused this high to be an inducement. So you mark this as your inducement. Yeah, marking this as an inducement, or what again? Then now you conscious that price is going to come up, clear this inducement and tap into your valid zone, right? Now looking at this, you can see price even kind of trading from this zone. Meanwhile, it's not the valid zone here because this is an induced zone. This is a trap, right, for sellers. So you might probably see people taking shots from here, targeting here. Some people might have not even taken this, waiting for change of character around there, then entering from this new zone, they get stopped out, right? So since you've marked your inducement clear, marked your time frame clear as well, right? Now looking at this, let's mark the correct time frame together. So we want to ask ourselves, because this is the extreme zone, right? From this, after this inducement, can you see any POI, correct supply zone around there? No. So we're going to use this one here. Imagine if there's something like this around here and there's another one here. Price can go with this one, right? Price goes with the closest valid POI after an inducement point, after a liquidity point, all right, liquidity level. So looking at this, since this was a bearish trend and structural break, we want to look for the bullish, all right, the last bullish candle. Now, where's the last bullish candle? The last bullish candle, right, can be seen here, and that's this candlestick that took a liquidity from this former candlestick. You can even see clearing several eyes, all right. This even cleared eyes from even here, right? Clear this eye, clear this eye, clear these eyes, all right. So this is a candlestick that cleared eyes. Looking at this, we can see that this is a bullish candlestick, all right. This big one is a bearish one, all right. This big one, when I actually analyzed this, then this was since when, around April or May or something, right? This is the weekly time frame. When I actually did this, then I actually extended it to this larger one at last, right? But that's after picking even my refined zone, so that was not even, so extending it to here was not, did not even make an impact, right? So following this bullish zone is a correct supply zone, because it actually has an FVG as well. There's a space between its low and the eye of the third candlestick, right? Between its low and the eye of the third candlestick. So price would magnet there and then fill that and trade away, right? So what again can we see here? Okay, we can make use of this, as I explained, that we can just use from the body here and to where, to this eye. This is what I did. You see, I did not even bring it to this eye. I actually just put it to this side. But there's something that I used to do. Instead of just, if I take this trade without a confirmation entry, instead of putting my SL here, I can just adjust my SL to around here in case of price wanting to maybe enter this eye and stuff, right? So, but like this is the correct zone here. But then let's just extend it to this eye. So on the weekly time frame, if we're taking this trade, this is going to be an hour trade. The sell side liquidity is going to be our target, isn't it? This sell side liquidity, but I already marked as a break of structure because price already cleared the low. Yeah, so we'll actually be picking the entry from here. You know, the weekly time frame. We use the weekly time frame. Use the weekly time frame zone and did not even refine. So we'll be getting around, getting a good 8-hour trade. So this is pretty awesome, right? Cleared the target after several weeks, right? I did not take it from year to year. Yeah, market is a swing trader, but I took so many of opportunities in this downtrend. This downtrend, I milked it as she. Bro. So looking at this gave us an 8-hour trade. Let's now refine to the daily time frame, right? I said from the weekly to the daily. Now going to the daily time frame. Going to the daily time frame, want to mark that zone around here, right? And now looking at this, where is the last bullish candlestick? This is the last bullish candlestick, right? This is the last bullish candlestick. Now, did this go above its former candlestick? Yes, it went above this former candlestick, right? Went above it. If it was this one has an eye like this and not go above it, but like this, it went above it. And what again do you want to see? There were averages around, even from year to year, there were averages. From year, there were averages all around, right? So the averages were everywhere. Averages were everywhere. So we can literally use this zone as the correct zone. So picking our refined zone from the daily time frame, using from the body to the eye here, right? And then marking it out. And now say this is our refined zone here. And now say this is our refined zone. All right. And now let's look at the RR this would have pulled. Let's look at the risk to reward this would have pulled. Because picking your entry from around that point, from around this point, and the SL slightly above. Even if we want to use our SL at this eye, fine. SL slightly above, like this. So instead of the 8-hour trade, an 8-hour trade would have had a 14-hour trade. A 14-hour trade, right? A 14-hour trade would have had a smooth 14-hour trade, right? So that's how to mark your refined zones following the time frame to go with that I gave you guys earlier. So just write that down somewhere, stick that to your brain, and let's make much more money with the understanding and finding our zones. So I want to thank you guys for watching to the end of this video, and I want to thank you guys for always interacting with my posts. Thank you if you're currently following me. Thank you if you have my post notification on. All right. So these are actually the things that would always propel me to do more, right? When I see that you're following me, when I see that you have my post notification turned on, right? So once I drop a video, once I drop any content on my page, you guys are always commenting, you guys are always reposting, because that reposting goes a long way. Even commenting goes a long way, right? Thank you guys so much. There is so much of content coming up for you guys. I'm actually thinking of doing a part 1, part 3 video on session trading, because I see that most of you messaging me about it, and we're just going to see to that. So kindly follow me, kindly repost for others, kindly always engage with my tweets when you see them with my posts. All right. Thank you so much. Let's end the video. If you have any questions, just drop them in the comment section. I'm going to reply them, and then I'll post some link to my Telegram group in the comment section. You're just gonna join and enjoy free updates, free money updates, so much more. My setups and all of that on the Signal group. So take care, guys. I remain King Solomon. Have a profitable week ahead.